We've just initiated coverage on Murray Income Trust. It's an investment trust whose objective is to achieve a high and growing income combined with capital growth. Now, the interesting thing is that objective is in order of priority, so high income, growing income, and capital growth. It's mainly invested in the UK in equities, although it can hold up to 20% of its assets overseas. Currently, that's about 15%. Murray Income Trust traces its origins back to 1923, and although it might not be immediately obvious from the name, it's been managed by Aberdeen since the year 2000. Aberdeen merged with Standard Life in 2017 to become Aberdeen Standard Investments. Aberdeen has always had a focus on buying the sort of quality companies that you can hold in your portfolio forever. Now, Murray Income Trust came under the pan-European team at Aberdeen, and the 4 UK managers in that team moved to a combined team with 12 managers from the dedicated UK team at Standard Life following the merger. Standard Life also has its own UK smaller companies team under Harry Nimmo. Now, as a result of the merger, the Murray Income Trust has incorporated some of the elements of Standard Life Investments' focus on change philosophy. So Murray Income Trust is still looking at quality companies, but also it's now considering what might change and how much of that likely change is reflected in the current price. Another result of the merger has been more specialist coverage by industry sector. The combined Standard Life Aberdeen team has coverage of the whole FTSE 350 index, and partly as a result of that, Murray Income Trust now has more mid-cap holdings than it did before. Half of the 16 new holdings it's bought in the last 12 months have been FTSE 250 companies. Currently, Murray Income Trust has 58 stocks in its portfolio. It's well diversified by sector, and it uses overseas stocks where there's no attractive UK equivalent or no UK equivalent at all, such as in technology, which makes up less than 1% of the FTSE All-Share Index, and an overseas holding in the trust is Microsoft, or sectors where in the UK there might be a lot of dividend concentration, such as healthcare, where Murray holds overseas stocks such as Roche and Novo Nordisk. Recently, the manager, Charles Luke, has been finding opportunities in unloved consumer stocks. Now, in the UK, consumer stocks are viewed particularly negatively because of Brexit, although some of the companies that are among Murray Income Trust's biggest holdings, such as Unilever or Diageo, actually have a really tiny proportion of their revenues coming from the UK. It's 6%, I think, for Unilever and 5% for Diageo, and the rest of that's all coming from overseas. In terms of performance, Murray Income Trust has performed pretty well recently. It's outperformed the FTSE All-Share, which is its benchmark, over 1, 3, 6 and 12 months, and over 3 and 10 years to the 31st of December 2018. And also it's currently ahead of its Association of Investment Companies UK Equity Income Peer Group average over both 1 and 3 years. Now, because of its focus on achieving a high income, Murray Income Trust has a healthy yield of currently around 4.5%. It pays its dividends quarterly, and during its last financial year, it rebalanced those dividend payments so that they're now more evenly spread through the year, whereas previously the first 3 interim dividends were smaller, and then there was a larger final dividend. There's a bit of gearing in the trust. It's currently around 7.5%, and it's currently trading on a modest discount of around 5% to net asset value. For those investors who are focused on costs, Murray Income Trust's ongoing charges of 0.69% are very competitive versus the AIC average of 1.5% for the whole universe.